Welcome back, everyone. Thank you for attending. And today we have a very nice topic. We're going to share with you two numerical formula that will make or break your financial
Mhm.
future in terms of your real estate investing. All right. My co-host once again is Julie. How are you, Julie?
Hi, I'm Seewing. Good morning. How are you?
Great, great. Thank you for co-hosting with me.
Of course.
always provide some great perspective. So let me go ahead and share this screen right here. And here we go. All right. This is the new rules of real estate investing. What I mean by that, these two numbers, the benchmark for how you build your financial future with real estate buying rental properties. Okay.
Mhm.
And the two rules are the 1% rule and the 30% first year return on your investment ROI. Okay.
Mhm. Mhm.
All you need to know, this is very high level. So if you follow this rule over each time you analyze any kind of deal, and you will set yourself financially free. So let's
Mhm.
dive deeper into it. What does it mean? Okay, here it is. However, that said, the most real estate gurus allegedly, a lot of them are,
Right.
fake gurus, and many YouTube content creators keep on promoting these following types of investment property, and
Mhm.
like their over exaggerated paper gains. Don't worry, I will dive deeper. What I mean, these are typical property that those people promote. Okay, one very large organization does this constantly, and
Mhm.
I know who we're talking about, but hopefully they have changed their philosophy of presenting, because they fire several of their main speakers because
Mhm.
they've been overhyping unrealistic
Mhm.
podcasts for several years.
Interesting. Interesting.
But let's hope they will go back to the realistic, more practical, more strategies. But with that said, not in just so many, majority of the YouTube content creators, fake
Mhm.
gurus, they promote this crap, okay, this garbage. I'm not saying there are always exceptions, right? If you're surrounding yourself with a great turnkey provider in a particular market, such as the one that you're in, upstate
Mhm.
New York, uh,
Mhm.
you have a very nice quality portfolio, even though those properties are quite old. But uh,
Right.
we talk about that many times. But let's talk about the mainstream media, which is it's just so sad the way they try to
Mhm.
educate the YouTube subscribers out there. Here's an example. Okay, in the Midwest somewhere, I hate to pick on Midwest. I'm not saying there's a bad market, but there are always some investors that are doing very well buying
Sure.
decent property. But I've been following this YouTube creators contents, Julie, for a long time, and I seen some horror stories.
Yeah, I bet you have.
The typical property, someone buying $69,000 property somewhere in the Midwest.
Right. Oh, Georgia.
Yeah,
Is that Georgia? Yeah.
and also another place like West Virginia, $34,000.
Oh my goodness.
Yeah, look at this. Yeah, it's just, yeah. And then they promote this buy low, negotiate 50% discount. You find a motivated seller, make ridiculous offer, then buy this property using BRRRR strategy, BRRR.
Mhm.
Buy, then you renovate, then you refinance, then
Right.
you repeat the process, right? BRRRR strategy is a very common mainstream, but there's so much risk to it, and we're not going to discuss
Mhm.
all the risk. We talked about it in other podcasts. Again, in Ohio, again, 67,000 property. Wow, get it undervalued, fix it up, rehab it, fix and flip, all kind of creative financing, all this unrealistic expectation. Oh, some young high school dropout, age 18, who have no credit, who have no income, able to accumulate 100 units in within 1 year. And with some of this podcast, they promote this kind of typical
Right. Right.
overhype, because that's not realistic and that's not practical. Okay.
Right.
Garbage podcasts out there. Yeah. Again, on paper, some of these properties may look good, high cap rate, high
Mhm.
cash return, very high cash flow, but underneath the paper manipulation, and you will
Right.
any investors that succumb to these overhyped investment strategies, and they take action, you know what's going to happen in the next few years? It could be a very short-term investor. Why don't you tell me why? Why don't you tell me why based on this graph?
If you're looking at the bottom two numbers, the maintenance and the vacancy, again, depending on what neighborhood you're in, it can really eat into your cash flow, eat into your profits, and just your overall strategy for the reason that you're investing.
Yeah, you buy these high cash flow properties in some of these markets for a reason because those properties are very old, 50
Right.
years old. Again, I'm not saying all of them are bad. If you know the right market,
Sure.
this system still are very good for you, become very successful. But that's more the exception than the norm. Now,
Correct.
this kind of property, the reason why they're cash flow because they don't appreciate that much. That's why they cash
Exactly.
a lot. So yeah, for C class, C minus class neighborhood, you have transient tenants
Yes.
that vacate your house for because they have unstable jobs and whatever. High vacancy, high capital expenditure, any kind of major items to break down, the water heater or the electrical system break down, the roof caves in. That's 5 or 10 grand out of pocket to fix
Yep.
it. And all your 3, 4, 5 years of cash flow is going down the drain
Absolutely.
because of the maintenance cost. So we have a solution for you, of course. The blueprint for you guys out there,
Nice.
if you can afford it, your construction, they are in better locations. They have a higher quality tenants. A typical tenant can stay 2 or 3 years or more. New construction is low maintenance cost, low capital expenditure, especially the first few years, not in the flood zone, away from the hurricane areas,
Right.
no high HOE situations, low insurance costs, no state income tax, preferably landlord-friendly state. You can evict very quickly, and you buy in the emerging market path of growth, low affordability, entry-level home prices.
Right.
Any quick comment on this?
I mean, that's I'm just thinking like the third, the last one, the landlord friendly state. That is much more important than I think a lot of people realize. And you can get a new construction in a landlord friendly state. That's a great combination. And I don't know if people realize what that means. You can basically, those of us in California understand we are a tenant friendly state. And the tenant you can take a year to get a tenant out. Whereas in a landlord friendly state, you have 3 days and you're out. So that does make a huge difference in terms of your vacancy rate, cutting down your vacancy rate, things like that.
That's right. You and I live in the Scoop area for many years. You live in Southern California, the area for many years, and experienced that. And we know all about it, right?
Know all about that. Yeah.
That's why you and I do not invest in. I have primary homes in Bay Area, but not investment property.
Right. Yes.
Yeah. With that said, Julie, I'm going to show you the two numerical formulas, which will make you successful over time. Over 1% rule and 30% total return on investment the first year. Those are the two metrics that you need to keep in mind.
Right.
Let me dive deeper. We can go through several markets, okay? New construction, everything, okay? So this market in Oklahoma, again, new construction, which is amazing, only 150K, mind-boggling.
That's great.
25% down payment, which is upfront, including closing costs, $43,000 for $1,350. So 1.9% is almost 1%. Okay, that's fine. 1% rent to value ratio, that means 0.91%. That multiplied by the purchase price equals to rent.
Correct.
50 to 1,500.
Correct.
Everything else is gravy because put 25% down payment minus the debt obligations monthly and expenses. At the end of the day, you have whopping $418 in monthly net cash flow. Okay,
That's really nice. That's a good deal.
amazing deal, especially new construction emerging market in Oklahoma. So anyway, and then the second metric is total ROI. Let me share with you ninth grade math how to calculate total return on investment, total ROI. The benchmark is 30%. In this case, 32%, right? So again, just pay attention to this ninth grade math, okay? Mess with you guys, right?
Exactly.
This is simple fundamentals, economics 101. If you have any level of common sense and fair amount of education in your particular in your lifetime. You guys watching. So
Mhm.
anyway, very easy to calculate. So you calculate the yeah, monthly cash flow 418 multiplied by 12 months,
Mhm.
little bit within a $5,000
Right. Right.
cash flow. Okay. Principal reduction, 1,300. You can afford to calculate this, but I don't know why my software did this. But at the end of the day, your tenants, by paying their monthly rent, they can decrease
Right.
the principal in terms of economic benefit. You 1,384, and then
Right.
at annual appreciation of 5%, 5% multiplied by purchase price 150K equal
Right.
at the end of the year $7,500 annual
Right.
net appreciation on paper, right? On paper only.
Mhm.
So you add on this number, you add on the annual net cash flow first year, add the principal reduction, and add the end of the first year, 5% appreciation, 7,500 equals 13, almost 14,000, right? And because this software does not have the ability to calculate the tax benefit,
Right.
or depreciation, paper laws, cost segregation, and a few other
Sure.
yeah, I could easily add on another couple of $1,000 the first year tax.
Mhm.
But let's not do that, okay? Let's be conservative, right?
Okay.
Yeah, so 13,902 minus your down payment,
Okay.
4,300 equals 32% first year at the end, total ROI. Make sense?
That does make sense. Absolutely.
Okay.
Yes.
Yeah. The subsequent pro forma on the other market I'm going to discuss, I'm not going to go through in detail because you are already verbally described to you how to calculate. So we'll do a
Mhm.
quicker evaluation on the subsequent pro forma on the other markets. Make sense?
Mhm. Okay. That sounds good.
The second market, similar in the same area, Oklahoma, brand new, 320K. Again,
Mhm.
almost meeting the 1% rent to value ratio. So you can see the
Mhm.
gross rent, 2,700,
Right.
5% down payment, minus all your debt obligations, minus your mortgage payment, minus taxes, insurance, property management fee. Monthly
Mhm.
net cash flow is pretty good, 813.
Nice. Very nice. Yeah.
Again, you add on to this three number, cash flow principal reduction, first year appreciation, goes
Mhm.
to 8,000 divided by $85,000 down payment equals 34% total ROI at the end of the first year.
Nice. Wow. Amazing.
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 Mhm.
I even factor in the vacancy rate 3%. Since it's a brand new construction, we don't expect any maintenance at all because you probably have a 1 year, first year warranty on any
Right.
renovation. And
Right.
so all these numbers are pretty realistic, okay? But then again, you and I know, Julie, this is just a pro forma. This is just
Right.
they could be wrong, but for the purpose of presentation, we have to go with
Mhm.
assumptions, right? So
Absolutely.
yeah, I'm trying to be as realistic as possible.
Yes. Mhm.
Yeah. So anyway, then some of these are Florida new construction properties. Now we're not getting the 1% rule per se, but how
Mhm.
we can offset that and it still equate to similar monthly net cash flow because the builders have a low or no cost buyers rate buy down incentive.
Mm.
This prime example, 4.755%, 30-year fixed rate mortgage, builders buy down. Okay. Even though it's not really at 1% because the rent is only 1,700 single family home
Right.
for his Central Florida. At the end of the day, because of rate is go lower, you factor in everything else, you still get a net monthly cash flow was almost 3. So you understand what I'm trying to say?
Yeah. Oh, yeah. Definitely.
It's not 1%, but you calculate the monthly net cash flow with the lower mortgage payment based on the rate
Mhm.
buy down, based on a monthly net cash flow, that pretty much equals 1%. Okay.
Mhm. That is good.
Yeah.
Excellent.
Yeah, excellent. And then of course a new duplex is less than 400 grand in Central Florida. Similar
Mhm.
situation. Rate buy down, 25% down payment, 1% rule pretty much. And monthly net cash flow is a whopping
That's
$526.
nice. That's nice.
Of course, we now can factor in the potential home equity growth because this kind of suburban
Mhm.
markets that we're promoting
That's true.
or in the path of growth and emerging market, the whole 9 yards, you're going to have migration of people entering this inland in Florida, away from the hurricanes, away from the weather conditions. not in a flood zone and low insurance costs because it's brand new, insurance company low,
Right.
and
Right.
no taxes, the whole 9 yards. And then again, 30% total ROI is
Right.
on this.
Right.
Not just in Central Florida, in many areas of Florida, we're promoting. We have 10 markets in the deep suburban Florida areas that we
Mhm.
do 1%. We do have 30% total ROI end of the first year because this total ROI at the end of the first year is going to increase. You know why it's going to increase? Judy, can you tell me why beyond the first year, the total ROI will be greater than 30%? Can you go over the multi-dimension aspect about income property?
Oh, right, absolutely. Yeah. Because then you're not just going to get your tax savings. We talked about that earlier. The tax savings that you get, the appreciation on the property, and being able to leverage it with the equity, leverage the equity on that. You will absolutely end up with more than the 30%. Mhm.
Yeah, absolutely. That's a nice recap. That's you guys, the audience. That's all you need to know for right now because
That's a great property. Somebody should buy that. That's a great
no.
property.
In fact, one of my investors already under contract.
Oh, wonderful.
It's just
That's really nice.
such a high quality construction, great market. The surrounding area of this property in South Texas is like next to a new high school, new elementary school,
Nice.
close to the major university of 30,000 students, like 5 to 10 miles away from several major hospitals. All the surrounding neighborhood is,
Yeah. You can't lose with that.
yeah. And this property meet the 1% rule. 1%
Unbelievable. Amazing. In Texas, a fourplex.
you can't get that anywhere in the South and Southeast.
New construction. There's so many advantages. New construction, even like the square footage. So each unit is a little over 1,000 feet, 1,000 square feet. That's bigger than a lot of houses. So I think you would get some very high quality tenants with something like with a property like that. And they'd be willing to stay because it'd be like, you have your own little home. So I think that would be a great investment there.
Yeah. Yeah. You're absolutely right, Julie. You recap everything. I don't need to go over the calculation because I already done it several times, but you can, for those guys, when you watch the webinar replay,
Right.
you will slowly pause on this particular screenshot and just
Mhm.
do your own calculation. So pretty amazing, right? For this
Right.
trophy quant to get this kind of this
Right.
1% rule and 30% total ROI. It's just such a no-brainer. People have those kind of money, they can do it, right?
Yeah, absolutely.
Yeah,
Mhm.
everybody can afford this. So this is just the tip of the iceberg, Julie. Not too many real estate mentor gurus out there promote this type. What is that?
I think when you move your hands, they create a little like celebration with them. I love it. I love it. See, if you know computers, they can do everything. I like that.
Oh, now I know. Now I bought a new laptop for this very reason. So, Julie, now these two metrics is need to be part of the person's research and due diligence. So, you and I, when we create this kind of podcast, I feel the contents and the education. I don't think you could get it anywhere else in any other to YouTube, any kind
Mhm.
of rules out there promoting. So, don't you feel we
I think we're striving to tell people the real picture, the reality of the situation, not to overhype it. There's definitely advantages in any market, but it's just really understanding that you've taken a lot of time to do a lot of due diligence, a lot of research in some really great markets, which create a lot of opportunity for people that are really ready to get started in investing. And it doesn't matter what level. We talked about, we were brand new to the investment arena. We knew nothing about investing and we're able to scale very quickly. Within about less than 2 years, we're able to acquire 6 properties on very limited funds, to be honest with you. So it didn't take us a lot. We weren't doing properties like the one in Texas there, but it really maximized the finances, the assets that we had. And now we're really working towards a really fantastic retirement with the 6 properties that we have. So yeah, it's just, we just want people to understand the truth and the reality of the situation in the market.
That's right, Julie. You said it 3.5 years ago. You were a newbie investor.
Mhm. Right.
Through my coaching and guidance and mentorship,
Right.
you were able to scale your portfolio in Buffalo, New York, on the 6 rental properties you bought under your name or under the name
Correct.
IRA. You and your husband,
Correct.
Mark, your portfolio have done very nicely over time, and this is just the beginning of your journey. So at the end of the day, Julie, people in your shoes who have a lot of fear, newbies, never done it before, just use you as an example. Anybody can do it.
Anybody can do it. Absolutely. You don't have to have a lot of experience. Just one thing, I am good at following a roadmap. So as long as you are teachable and you can take instruction and follow the map, you'll be successful.
That's right. That's right. Yeah, there's no reason why for newbies, similar to your situation.
Right.
And I put it there. You got to have a lot of courage, a lot of dedication. You got to do the work. You got to do the homework. You got to do the blood, sweat, and tear. And then
Right.
they take action because
Absolutely.
it's never a wrong time to buy investment properties. If you know the strategy, if you know what to do, if you know the numerical formulas we just described, 1%
Right.
and a total ROI the first year. Those are
Right.
metric. It's a simple mathematical formula. Okay, so
Right. Mhm.
ninth grade math. So
Right.
it's very doable regardless of
Very much so.
regardless of the economic and financial conditions, all the
Mhm.
no more the negativity out there. You just ignore it and focus on your plan, focus on your strategy, focus on your buy box, get some mentorship, get some coach,
Mhm.
and have a team guide you along the way long term. So you end up.
Right.
All right.
Absolutely.
Great, Julie. Once again, amazing having you on. As always, you
Thank
provide
you.
good perspective. Thank you for attending once again. And for those guys that is out there, if you see any value whatsoever on this podcast, please like and subscribe to my YouTube channel. And also put your email down on my website at the bottom with the description so you can become a free member of our real estate investing community. So every day you receive an email inbox so you can learn free about real estate investing opportunities and further education. Thank you, Julie. Thank you so
Thank
much.
you.
This is Seewing. I'll see you guys next time, next few days, another episode. Thank you.